This is your Wall Street wake-up call. The markets are quiet this morning as investors await a speech by Fed Chair Janet Yellen on Friday. For more, I'm joined now by Simon Smith, the chief economist at FX Pro in London. And Simon, it seems like the frequency of Fed communication lately has been so high that this speech on one of the last summer Fridays perhaps isn't as important as it has been in recent years, right?
I don't know if that's totally true. I think what we have seen from the Fed is a lot of contradictory signals. And I think that underlies the fact that monetary policy setting at the moment is hugely difficult. Usually, I guess, it sort of hinges on slightly differing views of the economy or inflation risks. But now it seems to be more fundamental differences that are coming up between Fed members on where we are and the actual role of monetary policy at this point in the economic and also monetary policy cycle. So I think markets are sort of looking for a bit of clarity from Yellen, but I don't think they're going to get the clarity around the September move. I think she's probably once too often tried to lead markets, as happened 12 months ago, into thinking a rate move would be pretty much a done deal, and it hasn't happened. So I think she's going to stay short of that.
Oh, and speaking of 12 months ago, you know, the markets are quiet today, but 1 year ago today, the Dow actually fell 1,000 points, and we had our first correction since 2011. Is that something you think might happen in the coming months? Are we set for another correction here?
It's always, the hardest thing to do is to time corrections. You can always look at any asset really and say this is overvalued, and then it goes another 10-15% overvalued. And so what causes corrections usually is number one, turning, investors running for the exits or walking for the exits, which then, eventually leads to a bigger sort of rush, and then the exits end up being closed because of lack of liquidity in markets, sellers with no buyers. So that's, an ever-present risk in markets. I think it's always more prevalent in August when liquidity is lower. So, that also exacerbates market moves. So I don't necessarily think that, given what we've seen over the last year, makes us more vulnerable to a correction at this point in time. But I think looking forward, then if investors become increasingly unbelieving of the fact that the Fed can keep propping up the equity market through its policy of low rates, and even if they do hike, they'll still be low rates. Then that I think where some of the vulnerability will lie.
Although if you look at the issues a year ago, we had low oil prices, worries about China and growth, Fed rate hike worries. Those themes are still in play today.
To varying degrees, they are still in place, but I think we still have, I think, in the background, a less clear picture on the economy. I think we're less certain of the global economic backdrop as we perhaps were a year ago. We were sort of relatively confident that we were entering a tightening cycle. In the US, if you think back to December of last year, the Fed was the so-called dot plot had nearly, I think it was about 4 rate hikes price for 2016.
Right.
So we've had 0. So I think you've seen quite a change in terms of the perception of the economic outlook and risk. That doesn't only stem from the US, it stems globally as well. Yes, you mentioned China, but also Europe as well, and the UK with the Brexit votes. I think there's a lot more sort of global uncertainty than was the case perhaps 12 months ago.
All right, well, Simon, we'll be watching this. Simon Smith, the chief economist at FX Pro in London. Thanks for your time. Thank you. I'm Scott Gamm, and you're watching The Street.